AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines.
Bay Area real estate and mortgage experts with over 25 years in the business.
Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today. This is the Real Estate Report. You can catch the stream at kdow.biz. You can also go to our website, bayarealoansource.com, for podcasts, as well as Facebook and YouTube for some videos. That's Bay Area Loan Source for all of those. Mortgage rates continue to kind of dominate the story, as well as home prices. Right now, Freddie Mac has the 30-year fixed at 5.1%. That's down from last week. A lot of people were encouraged to see that rates weren't continually going up. 15-year at 4.31% and the 5-year ARM at 4.2%. So the gap between the 30-year and the 5-year decreased a little bit. It was over 1% for a while, 1.15%. A lot of people pushed into ARMs, so that's why we're going to continue. That's why we always continue talking about ARMs, because there was always some sort of 0.75% difference or 1.2 difference, but people are talking about that a lot more. So that's kind of a side story to mortgage rates. What are the products that people are looking at right now? Do you want to add to that, Gordon? Because I think ARMs are going to continue to be a story as people look at these higher rates.
Well, ARMs are the story, as we talked many months ago. What I'm finding now, of course, the margin, like you just mentioned, between the ARM and the actual fixed rate is a little less. And it looks like as more and more demand comes for the ARM, it looks like that margin kind of just squeaks out a little bit extra profit for the investor. I mean, typically you're looking at a 1 to 1 1/4 swing between the 30-year fixed and let's say a 5/1 ARM, which is fixed for 5 years. We call it, we use the term ARMs generically, but we really mean a fixed term ARM. I mean, that rate is actually fixed for a fixed period of time. In this case, we're talking about 5 years or 60 months. And after that, it rolls into an adjustable. But for the sake of comparison, we just use the word ARMs. So as the market changes and different products become available, different demands. This week, of course, rates did dip a little bit, as he just mentioned earlier. Matter of fact, there were a couple of files that that lingered, and actually we locked them yesterday because yesterday was actually a good day to lock. The market gave a good reaction, and sometimes when you in a very market that had a lot of turbulence or up and down, sometimes you just have to pick your spot. Sometimes you just have to get lucky and lock in that rate at that opportune time, and you can maximize your benefit.
Yeah, some of the rhetoric we're hearing right now from the guys that kind of geek out on mortgage rates and yields and where the direction of where that's going, they're saying that we've kind of peaked on temporarily on the increase in rates, and we're looking at sideways motion. That, of course, every meeting that we're going to see with the Fed and what they're going to go with the direction on interest rates, which we know up, will determine what will happen with interest rates. But it's really kind of the verbiage that they use, Gordon. Lately, they've been looking for how it's not, because we already built in the expectations of inflation and high cost of gas, the war in Ukraine, and some of the other things going on. So it's already built in. It's really what are they looking at down the road? How is the Fed going to act? So they like that, being very flexible with their decisions on what they're going to do, as well as some of the other terminology. You see that as well in these rates, but we always talk about how it's already built in. So do you think we're going to see sideways motion for a while until we really start seeing some numbers one way or the other?
I think even though the market, all the indicators, we're looking to actually control inflation by actually raising interest rates, I think the Fed still have to do some treading water. They just can't just raise rates because it's needed to be. I think you have to take in consideration the overall market consensus, other economic factors that are actually affecting the marketplace, and just have to kind of weed through it to where it kind of works through where everybody benefits. If we continue to raise rates, of course, costs, everything goes up, credit card charges, car loans, home loans, everything goes up. And we already have extreme gas prices. We already had the war in the Ukraine. We all have all these other external factors that are separate from the market that will have a gasping effect on the market. So I think that's the balancing act that the Feds actually have to do to manage us through this actual crisis.
Yeah, there are also a lot of the economists and traders and investors are kind of measuring how well they're doing juggling, this task that they have in front of them, and that's to keep this from getting way out of control. So they're also measuring that as well in when they determine on what they're going to do with their money. It's all about the flow of money right now. Meanwhile, mortgage applications are kind of a direct result of what happens with mortgage rates. They fell again for several weeks already, down 2% from the previous week. And we're 75% lower than the same week 1 year ago. So applications are 75% lower than they were a year ago.
And what that means typically, as we talk in our business here, our business is what we call a lag business. So right now, if we're at the end of May and applications are falling, that means closed volumes for June is going to be down because we work on normally a 30-day excitement calendar. So everything you do today excites in 30 days. So when come June, which will be the end of the second quarter, we will start to see not only mortgage, if applications continue to fall, we'll see volume fall, and hence we'll start to see prices kind of fall in line along in that same barrier.
And that's the other part of the story is like how are rates affecting the real estate market, sales, home prices. All of those numbers, as you say right now, are kind of lagging, but they're and I don't want to say they're artificially up because they're real numbers. They're just a little bit behind. But we're looking at prices year over year, 16% in April. We're looking at seasonally adjusted home sales. They're down 8%. Seasonally adjusted home sales for sale fell 9%. New listings down 7% from 2021. Time on the market, that's down to 18 days in April. That's a number we talked about earlier today. We spent about 30 minutes talking about days on the market, and we believe we're going to see that creep up. And we've been talking about that for years, about how that is one of the first indicators that we're going to see, because that you don't have a sale until you actually get in contract, days on the market, and then average sale to list price ratio, it hit a record high. So that's a snapshot in time. That's what we look like in April. A little bit into inflation, a little bit into higher interest rates. People are still, looking to snap up a home and figure, while they were still inventory was low. But now the story, Gordon, as we start looking at these numbers, is sellers. Sellers are now trying to take advantage of the higher interest, the low inventory, and get their highest home price that they believe they're going to get. That's where we're going to start seeing the inventory come in.
Well, we are beginning to see a lot of inventory. As we drive through the town here where the office is located, we're seeing a lot more sales, a lot more activity than we've seen before. As part of the realtor chain, even though we do with mortgage loans, we are all excited in that connection. We see a lot of things coming across our wires and our emails, price reduction, announcement of open houses. Typically, you didn't have that before because the market was moving so swift and we didn't have a lot of inventory. But as more and more inventory comes on the market, realtors now have to go out now and kind of modify their plan on how they're going to sell these houses and how they're going to get those houses sold for the sellers. But more and more sellers now we're seeing are putting their properties on the market, one, either because of inventory, or two, because of signs of the time. They realize that as rates go up, eventually higher rates would lead to, hence, lower home prices. So a lot of people are now trying to capitalize on that by putting their properties in the market, because we do believe that based upon what has happened in our business year to date, we're halfway through 2022, we will begin to definitely see some effects in the marketplace come to the beginning of the third quarter, which is September, October.
Redfin reported that new listings rose twice as fast in the 4 weeks ending on May 15th, 11 days ago, than they did the same time last year. So Redfin is reporting twice as many new listings as of 10 days ago as we saw last year.
So that's along the line.
Right there,
these
are snapshots in time, of course, but that's a pretty significant number that a large company in the United States is seeing new listings doubling the pace that they did the previous weeks. Or previous year.
Is there a geographic area they're speaking of, or
nationally.
That's just nationally? Okay, well, these things do happen, and I mentioned earlier, I misspoke. I said beginning of the third quarter, meaning end of the third quarter, which is actually September. And these are the things that we see because time is what takes place in our marketplace, and things adjust as time go on. We're right now we're coming out of the spring, moving into the early summer. June is typically graduation month. Matter of fact, my daughter just graduated from St. Mary's on last Saturday, and when I was driving up to the campus, I saw a lot of for sale signs on that main street, which typically you didn't see a lot of for sale signs, which is an indicator to me that people are looking to feeling that higher rates will lead to lower home prices and people trying to capitalize on the opportunity while the market is still hot.
I think that's something people need to pay attention to, not just the visual of seeing more houses on the market, but that's the kind of a mindset that sellers are in right now. A lot of people are looking to capture in those gains. It's the highest their home value has ever been. Plus, it's not just that; it's other people. Like there's a property we were looking at, Gordon, that the people bought it a couple years ago. They went out, got some plans, but never some financial reason they weren't able to fix up the property, and now they're like, you know what? I'm going to try to sell this house without fixing it up and at least get my money back. So, and that's just the exposure that we have as a brokerage. Imagine how many other places around the Bay Area and the United States are seeing these types of this phenomenon where people are just wanting to capture it. Now, I'm not changing my tune that much. We are still 3 years ago, 63% lower in inventory from 3 years ago, 52% lower than we were last year, 2 years ago. But we're up, I think 9%. I'll find that in just a minute. 8.2%.
2022
from 2021
to 2022.
So we're seeing inventory rise from last year, but the previous 2 years we're 63% lower than we were 3 years ago. So we have a lot of room to make here. The question is, will interest rates, the higher interest rates, eliminate enough buyers to where the lack of inventory starts
flipping the
eroding our home prices?
Yeah, flips the marketplace.
Yeah,
if the lack of inventory, if you take more buyers out of the market, now you have less buyers, you have more inventory. We're kind of going to swap the terms of the market. We talked before, we're going to move now from possibly a seller's market into a neutral market, which sometimes, depending on how long this thing lasts, into a buyer's market.
Fannie Mae chief economist says the U.S. housing market has finally turned a corner. Here's why. We'll talk about that when we come back after the break. I'm Tony Mendez. That's Gordon Hines. You can always catch us at BayAreaLoanSource.com. It's also our Facebook and YouTube. You can always email the show, Tony or Gordon at BayAreaLoanSource.com, or call the show, 800-516-1220, 800-516-1220. We'll be right back here on AM 1220 KDOW.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
So we just got off talking about kind of the state of the market, the real estate market, and which direction the home prices are going to go. Are we turning a corner towards a buyer's market, or at least a normal market or balanced market before we get to a buyer's market? I don't think we're going to get to a buyer's market. I think we'll definitely get to a normal market first. Chief economist at Fannie Mae, he said that we've already turned the corner. He bases that on the inventory coming back up. We see rates up. We've seen the Redfin even came out and they said that home buyers are 1 out of 5 sellers. I'm sorry, not home buyers, but sellers are dropping their price. That's the highest rate since 2019. So all of these numbers are starting to really get put together. Do you think I don't think it's too. I personally don't think it's too early to start talking about this, because this is what we are going to see for the rest of 2022, and we just don't know how long in 2023. We don't know when it's going to change. It's all based on rates and the consumer sentiment.
Well, if you look at a formula, it depends on how long we stay in crisis. Then we look at how high rates go. We might just bypass the neutral market straight to a buyer's market simply because of affordability. Every time a rate goes up, it's harder for more and more people to qualify. So every time a rate goes up, you take X amount of people out of the formula, out of the capacity, ability to buy. So a lot of these things, if they all happen simultaneously at once, like as we say, the perfect storm, if we have the perfect storm, we can definitely see this crisis become faster than you can actually think and move right through that neutral market into the buyer's market.
Daryl Fairweather, Redfin chief economist, he says the picture of a softening housing market is becoming more clear, especially to home sellers who are increasingly tuning into price drops as buyers become more cost conscious under high mortgage rates. He continues saying, for now, mortgage rates have stabilized, and I expect prices to do the same. This will remove some uncertainty for buyers. That means that as long as a home is priced conservatively, it still has a good chance of selling quickly. Some of the leading indicators that they base this information off: fewer people are searching for homes on Google. The seasonally adjusted Redfin home buyer demand is down 12%. Touring activity for the first week of January through May 22nd was 29% behind the same period in 2021. Mortgage purchase applications were down 16%. And for the week ending on May 26th, 30-year mortgage rates decreased slightly. So there are some signs here, Gordon. I personally, there's no panic. There's no reason to panic. Remember, we're still 50% below the inventory we saw 2 years ago. We need a lot more inventory to hit the market. Builders are the other half of this, Gordon. We saw some charts showing what happens with builders and the inventory that they keep throughout inflationary periods. Now, I'm not saying we're in inflation yet, but recessions. I'm not saying we're in a recession yet, but we're kind of headed that direction. And their inventory even drops. They cut back. So where's the inventory going to come from? It has to come from the sellers. And if you're a seller, you still have to face the fact that if you're going to rebuy with a mortgage, you're going to get a higher rate. So a lot of people are still looking internally. They're looking to improve the properties that they have. Construction numbers are looking fantastic. The Architectural Institute, they're showing really good, solid numbers. So there's still really good numbers showing that people are going to hold their houses. And I don't think there's going to be, we're just seeing these numbers right now because this is the time of the year where inventory hits the market. That's just my opinion.
Well, I mean,
no panic.
It's not a panic yet. I think an area of concern, yes. I mean, because one of the things you have to be able to do is to predict what's going to happen before it actually happens in order to kind of survive a marketplace. You know, you don't buy insurance after you have an accident. You predict that, hey, listen, if I drive, I'm having an accident, so you buy insurance prior. So when the accident does happen, it is covered. Builders, for example, builders that have X amount of homes slotted to be built in X amount of period of time, they start to slow these things down because what the worst thing for a builder to do is to build a whole tract of homes and then have all these homes unsold and staying vacant. The longer they stay vacant, vandalism, all kinds of things takes place in these properties. So it's a losing, and they're paying interest on these loans. So a lot of times you'll see builders start to cut back and kind of just hold the fort till the actual demand actually picks up. And of course, sometimes they try to create an artificial demand by limiting the amount of houses that they have that they release for sale, through the different phases. So a lot of different strategies have to go into a marketplace like this, because a lot of times is when things are good, which they have been for the last 3 to 4 years, people that are new to the market, that aren't accustomed to these changes, those are the people that hit the panic button simply because for them it's uncharted or unthreaded water, because they've never seen these type of things take place before, because as far as they know, all the market does is rise, because that's all it has been doing since they've been paying attention. Yeah,
it's something, same thing with rates, right? A lot of people were accustomed to these rates, and people are like, 5% rates. I remember when I did 5 and an eighth interest rate, and I was jumping up and down. I think I was sending out email after email saying, these are the rates we can get. And that was on an investment property. And yet, my rate I have on my investment, one of them is 3 and an eighth. And a lot of people got those since 2013, when the rates hit the lowest they were before we saw them last year. So people get accustomed to these kinds of trends, but this was a long trend. 10 years plus, Gordon, we saw with home prices going up. And, what do we do now? We have a lot of millennials that are looking to buy, and they're looking at home prices going, I can't quite afford that. I'll just move. So there's a huge number. And I was just looking for that story where millennials are basically saying, yeah, we're going to be that generation that says, we're going to go to affordable cities in the United States. And that's where that migration is happening. Does that help a place like the Bay Area? I think it does in a way. It keeps, I don't like really saying this, but it keeps like the quality buyers here. There's going to be plenty of them. There's a lot of money here. We're seeing people using stocks still to buy properties, and there's a lot of really still solid incomes here. Dual incomes can certainly qualify for the mortgages on a medium-priced home in the Bay Area with 20% down easily. So I feel pretty safe about a place like the Bay Area. But you're looking at some of these places across the United States, that smaller towns. I think like Austin, Texas, and a lot of places like Boise and other places across the United States that are just looking at higher home prices over and over and over. And yet their economies haven't quite picked up because a lot of people are bringing out of state money. I think that's where a lot of this news is going to hurt. A lot of people are hearing that as opposed to a place like the Bay Area where there's just the demographics are so different.
Well, if you look at rates, I think right now, if I was to plot it out on a calendar, I'm pretty sure we're about a 20-year hiatus since we've seen rates mid-fives, high fives, as far as the 30-year fixed mortgage is concerned. So, as I mentioned earlier, people that have been not in the game for a long period of time don't know what those rates are like. Or, those are the people hit the panic button. They want to jump ship. Haven't seen, hey, my house, I bought a house last week. It didn't go up this week. Same thing in the stock market. When things are good, we make decisions and plans and because on them being good. And when they're challenged or stagnant or actually worst case going down, people definitely hit the panic button and are looking to throw in the towel. So these are all the things that we have to prepare people for so that we can actually navigate through this so we don't hit the panic button, because panic sometimes causes things to be worse than what they actually are.
We'll come back after this break. We'll continue talking about mortgages, real estate, anything that is in between. You can always reach us at BayAreaLoanSource.com. You can call the show 800-516-1220. You can email the show, Tony or Gordon, at BayAreaLoanSource.com, as well as our YouTube and Facebook. That's Bay Area Loan Source. We'll come back after the break. This is the Real Estate Report on AM 1220 KDOW.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Thanks for being with us today. Mortgage rates, 5.1% on the 30-year fixed, according to Freddie Mac Weekly Survey. The 15-year at 4.31 and the 5-year ARM at 4.2%. Those are all down except for the ARM. The gap between the 30-year fixed and the 5-year ARM has shrunk a little bit, but it's still not deterring people from going towards the ARM as an alternative to continually getting lower rates. I mean, 4.2%, fantastic. You can get that up to $647,000, I believe, on a conforming loan. That's pretty much what this survey measures, is all conforming loans. It's a little bit higher for your jumbo. Your what they call high balance, and then depending on which jumbo lender you go to, you might get about the same. We actually priced out a couple jumbos today that actually beat on the 30-year fixed, beat the high balance. And some people, the high balance 30-year fixed from Fannie Mae. So Fannie Mae doesn't always have the best rates, and jumbo is competing with these with Fannie Mae and Freddie Mac. Jumbos don't go to Fannie Mae and Freddie Mac. They're either sold to a private investor or held within that bank's portfolio. And then you have the whole non-QM, non-qualified mortgage market, which is really exploding because of higher debt ratios and just some looser guidelines is probably the best way I can describe that.
And that helps the people in our area a lot better, because if you get better pricing on a jumbo than you get on a high balance. Typically, most of the loans that we operate in the $800,000 range are higher than conforming jumbo. So if you can get a higher loan amount with a lower rate, you're throwing all aces.
So we're going to talk a little bit about ARMs, adjustable rate mortgages. Gordon likes to make sure everybody gets corrected on this, and I get corrected, is that it's a fixed adjustable rate, which means like a 5-year ARM, that means it's fixed for the first 5 years, on a 7-year fixed, 10-year, and so on. But there's some advantages. I wrote a little thing in Facebook. I think I sent it out in email as well. About the difference. It's about $6,000 a year difference on a $600,000 loan as of about a week and a half ago, for the difference between a 30-year fixed and the 5-year ARM. And that's a big difference for somebody who's looking to, watching higher home prices, watching interest rates go. And I can ride this out for 5 years and we'll see what happens. And then I also gave some explanation on how it's not just about the 5 years. You can actually go into an ARM and watch interest rates rise, watch your payment go up, but you've still saved money over a period of time because of the first 5 years of savings. So there's some advantages to using an ARM. We're seeing It'd go back into double-digit usage in the United States. I'd be curious to find, and if I can dig that up, the number on new purchases. What's the percentage of usage on ARMs on purchases, and then you could break that down into loans that are in jumbo territory. I'd be surprised to see that number falling right now, because when you do $1 million plus loan, the difference in 1% rate is thousands of dollars in many cases. We'll come back and talk a little bit more about that when we come back after the break. I'm Tony Mendez, that's Gordon Hines. You can always reach us at BayAreaLoanSource.com, Facebook, Bay Area Loan Source. You can always call the show 800-516-1220, 800-516-1220. You can always stream the show if you didn't catch it all, or get our podcasts at the same place, BayAreaLoanSource.com or KDOW.biz. We'll come right back after this break here on AM 1220, KDOW.
Got a question? Run it past these guys.
800-516-1220.
It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
You can always reach us at BayAreaLoanSource.com, or you can call the show 800-516-1220, 800-516-1220. The adjustable rate mortgage offers the largest savings since at least 2015, according to this recent report. Trying to find out. It was a survey done by Freddie Mac showing the difference in the payment of 11%. 5-year ARM showed an estimated payment of $21.64 during the 4 weeks ending in May 12th. That's roughly 11% lower than the $24.23 payment for a 30-year fixed. Adjustable rate mortgage made up of 10.8% of all mortgages. I've been saying 11 applications during the week ending on May 6th. That's up from 3% at the start of the year. Gordon, we just kind of talked about ARMs, adjustable rate mortgages, what they are. Let's talk about some of the advantages they are for people, because that's where it is. I kind of gave a brief note about how you can keep an ARM, and then what if rates go up and you're stuck with an adjustable rate mortgage where the rates are going up? You've still saved money. Explain a little bit more about why somebody would do it, and then I'm going to come back and talk about why people are kind of afraid of doing it.
Well, a lot of times, people are always afraid of the uncertainty, but if you look at a standard 5-year ARM, it means you're going to have that rate and payment fixed for 60 months. On your 61st payment, that loan is going to adjust. It's not a balloon. All the money's not due. You have 3 options. You can refinance that loan to another fixed rate ARM. You can refinance that loan into a 30-year fix, or you can stay put and ride the market, depending on where the market is at that time on that 61st payment. And of course, there are notifications of what that payment adjust is going to do and how it's going to adjust based upon the index that fixed rate is tied to, and based upon the margin. The margin is the bank's profit. The index is something that we use as a standard to direct us to the cost of money. Like, for example, if it's tied to the 1-year treasury, we'll take the 1-year treasury rate. Let's say it's 3%, margin of 2.5. That rate would be 5.5%. Add those two together. So it's not as perplexing as you think. Nothing scary. Rates aren't going to go from 5% to 12% on that first adjustment. There are caps that can tell you how it can go. Even the market said in worst case scenario, it might only go up 1% or 2% every adjustment. So these things are all predicated and determined up front while you sign the dotted line. So I don't think it's something to be really concerned about, especially when you have options.
The other thing that you've talked about too is the average time that people keep their mortgage between like 6 and 7 years. So a lot of people right now are aiming for that 7-year ARM, which isn't that far priced off of the 5-year. And why not save some money along the way? I like the ARMs because you know what you need to do over that 5 or 7, 10-year period. Let's say you're going to keep this as an investment, or you're going to live in it and move and upgrade your property, or you're going to refinance anyway. There's a lot of things. There's something we learned as well. We're going to get into some products. There's a really interesting ARMs are supposed to. Are you ready for this? Are they supposed to? Based on the servicer that you have, when you put a large chunk of money, it's supposed to recast and change the payment based on your new balance. And that's a lot of people like that feature, especially if they have bonuses and, I have an inheritance coming up and you want it to recast to the new balance. There are some of the other advantages. Other people get ARMs because I know when I first met you, you said all of your loans are ARMs. And I was like, oh, really? These are kind of, and you said, no. And you were writing, the low indexes at the time. And a lot of people, even since 2010, after the shakeout, we saw low indexes and people really enjoyed the ARMs. But a lot of people converted those 30-year fixed because there wasn't the difference between the 30-year fixed and the ARMs shrunk considerably during that period of time. People were just opting for the 30-year fixed, saying, I'm never going to refinance again. Yet
they always do.
They always do.
And one of the great things about ARMs, I don't mean to cut you off, but one of the great things about ARMs is even at the adjustment period, equity does not come into play. So regardless of, let's say that property's lost 50% of its value, it would not affect the terms of your ARM because the terms of your ARM was spelled out at the time of purchase. On the adjustment period, what you could do, if push came to shove, you can also add some liquidity into your loan. Let's see you had to come up with a lump sum of cash. You can infuse some cash. And once again, when that payment adjusts, that payment's going to adjust based on the balance. Unlike a fixed rate, regardless of how much you pay into principal, the payment stays the same. So that's another factor that you can learn how to maneuver and manage your portfolio like we all do. And there's all kinds of things out there, education on these things, how they work on the web. All things that we talk here is to make you a better consumer. The better consumer, informed consumer you are, the better decision maker you can make, and a better way you can manage your portfolio, and of course stay on top of your game when it comes to finance.
So adjustable rate mortgages, and we're talking again about this because they are coming back. And now it's only 11% of the mortgages that are being originated right now, but we believe that number will increase as people kind of assimilate the new interest rate environment that we're in. The Fed is expected to raise rates continually. We'll see how those affect the mortgage rates. Inflation is a factor. So people are looking to, their milk and gas and everything, travel, hotels, everything is more expensive now, and people are looking for every way that they can to continue to keep those payments manageable. We didn't even talk about reamortizing. A lot of people refinance for reamortizing purposes. If they can keep the same rate, but they've been in for 5 years, you still have a lower payment because you're reamortizing it over a 30-year period, which an ARM is as well. So there's other advantages of doing this. We were talking about getting 15 years and 10-year loans, 20-year loans back when rates were lower. Now we're talking about ARMs. It's kind of an evolving market. Now we're not promoting these as this isn't the only thing we do. Most people still get 30-year fixed. In fact, 89% of people are still getting 30-year fixed mortgages. But I believe that will change as people start figuring out. Now, the reason why people were fearful of this is because we came out of a mortgage era that led towards the Great Recession, a crash in the market, in the real estate market, so to speak. And a lot of it had to do with these risky mortgages, and a lot of them were ARMs, the pay option ARMs, the teaser rates, and they just kept going on, and they didn't really work out for people. It wasn't a true representation of what people made and qualified. But now people have we have qualified mortgages, and people actually have to make the money. They have to prove the ability to repay. So it's a much safer market to be in this type of environment. And I could see ARMs going to 50, 60, 70% of the usage in the United States and still not affected because of the way they qualified. We didn't have the rules that we do today.
Well, you got the benchmark, like you just said, has been the 30-year fix. That's what we use. That's what we use to qualify. That's what we use to compare. That's the pretty much standard in the industry. Sometimes, we talk on the show. We got 25-year fixes. We got 10-year fixes. We got 60-year fixes. We can adjust your fixed rate period based upon your payment. But still, even though we have those options, majority of people still back themselves back into the 30-year fix because that's the standard. That's the comfort level that they believe in, and these things I do understand it. But if you can re-educate yourself to get yourself more informed on the different options, how to make these options work for you, you can see that what we're talking about here in this show can benefit you if you are in the marketplace, especially long term. You have kids that can follow what you do, and you can always do everything on the schedule to see how you're doing.
We're going to come back after this break. I'm Tony Mendez. That's Gordon Hines. In the meantime, you can always reach us at BayAreaLoanSource.com. You can always catch us at Facebook and YouTube, Bay Area Loan Source. We're going to come back. We're going to talk about recasting. I briefly talked about that on a 30-year fix. Yes, you can, for example, say you own a house. You want to buy a new house with a 30-year fixed. you want to sell your house, your old house, and then take all of those proceeds and put it in a loan without doing a refinance, that's what we do. It's called a recast. It's a one-time recast, and your payments will go lower because your balance is lower. Most 30-year fixes don't do that, but we have it. We'll talk about that when we come back after this break.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Okay, so what is a recast? Recast, I'll give you an example. Let's say that you own a house, you want to buy a new house. You have enough money to buy the new house and you qualify, but you really want to use the equity from your old house to put into the new house. So in the old days, we used to use bridge loans, right, Gordon? We would get a loan, it'd go up to 100% to the current value, and you tap that equity, and you would put that as a down payment along with any other money that you have on the new house, and with the kind of promise, the expectation, I think you had like 90 days or something like that to sell your old house, and then you just pay off that old loan. And they put two liens on, a lien on both properties, and that was the old way. Then that kind of went away, and then now you have to move somewhere. You have to do another refinance to put the money in so that you now have the lower balance. Well, what we really wanted was what they call a recast, where you're able to put like a one-time large deposit into your loan, into your 30-year fixed, and it will recast to the new balance. Now, it doesn't change anything else on your term. In fact, it doesn't change your term at all. You just go right back on it. It's like as if you have an arm and you're lowering your payments. It's like a true adjustable, but a one-time true adjustable. So these are back. We're happy to say as a alternative for people that want to sell their house, but they just don't want to move twice. So they buy the new house and then they sold the old one, and then they take all that money and they dump it into that new loan that they just got, and they do a one-time recast. And it costs $150. Takes like 3 weeks to do. It's perfect.
Interesting. I got a call from an agent today. Agent is also a buyer. Agent bought a property in X city, lived there for 10 years, bought a house 5 blocks away, double the size, larger family, and she used private financing because she needed to close the deal swiftly. She has good credit, but it was a short escrow. It was a competitive bid, and her offer was she can close in 10 days. So in order to close in 10 days, she had to go out and get private financing. So to the tune of, she got 100% finance, and this private company did it for her at 8% on $800,000. So now she's looking to refinance that property that she bought. She's looking to move from her current residence, which is 5 blocks away, to new residence, and of course, rates are higher than she anticipated, and she called and see can she do an FHA loan on that, because FHA probably has the lowest rates right now. Do you have the answer?
Well, probably. You could probably do it. Yeah, as long as she qualifies. The thing about FHA, and most people use FHA when they have low down payment or something on their credit score or a credit event. FHA is more lenient on debt ratios as well. So there's other reasons why you would use FHA, but because you also have that mortgage insurance and the upfront mortgage insurance. So I always try to use FHA when it's appropriate, but it's not it's not just about the interest rate. Yeah, you could get a 1% interest rate lower than the 30-year fixed from Freddie Mac, but you have mortgage insurance and that upfront mortgage insurance. So, but it does have its uses. We've done many FHA loans. I don't know if that answers your question.
Yeah, but in this particular circumstance, unfortunately, she doesn't qualify for FHA because she could use FHA. FHA is an option, but unfortunately, in order for her to use FHA, she'd have to qualify with both payments. FHA would not allow what they call the departing residence rule, and that she's going to rent the property she's moving from, use the rents to help qualify, unless that property was at least 100 miles away. So FHA is not an option. So now she's looking at a co-borrower. She says she's got a cousin that doesn't own a house. So we can do that as a co-borrower, non-occupant co-borrower, which probably now can bring FHA back in the picture, because with that person hopefully bringing more income and more assets, now we can use that person to help qualify for both mortgages.
And you won't need the rents from the departing property.
And we won't need the rents from departing property. So hopefully that deal would come in place sometime next week. But these are all the things that we get calls on. And this is a realtor who is also a customer. And myself, as a mortgage broker, I'm also a customer. So I also do shop rates for myself and understand the market, terms and conditions. I understand the consensus of how the market works. So if I am doing a property, I won't panic because something didn't go the way I planned, because that's part of business, part of life, is you always have to be ready for the unplanned or unforeseen event that can kind of throw things in a tailspin. But if you understand and you've been doing it long enough, it can keep you right on track.
One more kind of product announcement is that, we've always talked about how large banks are really looking for that perfect client, 800 credit score, lots of assets, W-2 income, no other properties. And they, kind of reward them with good interest rates, right? But as far as brokers, I don't say we were left hanging there. We have great products, great rates, but there's a couple of brokers that are coming. Wholesale lenders that work with brokers that are coming out and saying we're going to steal all of those loans, and they're coming out and saying we have those A-paper jumbo loans. This is purely about jumbo, so it's good news that everyone That's kind of what the environment is right now. Like it's these wholesale lenders that work with brokers are competing against large banks, the Wells Fargos, the Bank of Americas, the Chase, and so on, and they want their piece of the action, and they're really putting together a lot of good products. And we haven't even talked about the non-QM, which is what's called non-qualified mortgages, where they're what they call near-miss products. So if you near-miss Fannie Mae or Freddie Mac, FHA, or your jumbo, you can go to these products. You have the bank statement products. I like the bank statement product. The asset depletion. There's an asset depletion loan where Fannie Mae and Freddie Mac, they do it for 30. They do it 360 months. They divide your assets by 360 months. So if you have $360,000, that only gives you $1,000 a month. We have a program that does it for 3 months. I'm sorry, 3 years. 3 years. So you take 3 years or 36 months. So that's a $10,000 income that you can use to qualify. Yeah, the rate's a little bit higher, but all of a sudden, your $360,000 is buying you a house. Well, also and that's without any income.
Yeah, some of these, one thing I like to piggyback on, it's important because some of these lenders that are being competitive now have what they call a portfolio product. These guys don't need the Fannie Mae, the Freddie Mac guidelines because these loans are not going to be sold in the market. So they can actually write their own paper and tailor it to the needs of the customer. And some of the community loans fall right into those categories.
We're excited about these times. We've been kind of waiting for some changes. We're seeing this right now in the market. The snapshots in time showing a little bit more inventory hitting the market. Rates are higher. There's a little bit of action going on. It's exciting to kind of get right back into what it was like in the heyday.
Make it a golden state.
Make it a golden state. Thanks for joining us. I'm Tony Mendez. That's Gordon Hines. You can always reach us at BayAreaLoanSource.com, or you can email us, Tony or Gordon at Bay Area Loan Source. Thanks for joining us here on AM 1220 KDOW. We'll see you next week.